and get started. So, hello everyone. Thanks for joining us. My name is Shannon McNulty. I'm a trust and estates attorney in New York City. And joining us today is Alison Hutchinson. She's a managing director at Brown Brothers Harriman and has leadership roles in a variety of areas there, including trust and estates and the tax planning group. So Ali, we have just come off a pretty crazy week after an unprecedented election. And I think we're all breathing a sigh of relief for one reason or another that this election is over. Before the election, there were some talk about different actions that it might be a good idea to take before the election in case there is some kind of political change. What were you advising clients sort of like prior to the election? What were some of the concerns that you had or clients had about tax rates changing or anything that they might want to change with respect to their portfolio or their estates and tax planning?
Good question, Shannon. And I wonder if some of the people watching would agree with you that the election is over. We think it is, but I know there's still a Senate runoff coming in January, which I think we'll get to a little bit later. So to answer your question, really, our clients were thinking about a bunch of different taxes, income taxes, of course, and then also estate and gift taxes as well, because the proposals for the presidential candidates were very different when it came to tax, right? So President Trump's proposal was to basically just extend the 2017 Tax Cuts and Jobs Act past 2025 when it is scheduled to sunset. His perspective was, I got my tax policy in place in 2017-18, and I would just like to make that permanent.
And then the Biden of what the 2017 tax changes did.
Sure. So the big changes there were, I'd say across the board, a decrease in tax, right? So it's kind of a Republican platform where in general, the preference is to have lower income taxes, lower estate and gift taxes. For trust and estates lawyers like us, the big change was this exemption from estate tax. So right now, just for federal purposes, if you pass away with a taxable estate, and that changes based on the tax code, but if your estate is taxable, those assets are subject to a 40% federal tax. The Tax Cuts and Jobs Act basically made almost everyone's estates exempt from that tax because it raised the exemption amount, the amount that your estate could be worth and not be subject to that, to about $11 million. Where it is right now is 11.58 million. That act brought it up to 10. So a married couple together right now, because of that act, can pass about $23 million to their heirs and not worry about the estate tax or the so-called death tax. And the Republican proposal was to keep that going.
Vast majority of people would not have to worry
at all.
My clients really have to worry about the estate tax, at least at the federal level at all.
Right. And for your clients in New York, it still has a pretty high exemption from the state level of 5.85 million. So while it can be a hot button issue and people are always concerned about the death tax, it sometimes feels to some of our clients like a double tax because they've paid income taxes on those assets. They own those assets, and then there's a tax at death. Really, it doesn't apply, especially after that 2017 act, to very many people at all. And the Biden administration recognized that. And one of the proposals was to return estate tax rates and exemptions to the quote as historic norms. And really no one knew quite exactly what that meant or means, but the Tax Policy Center came out with a great paper basically trying to project the revenue impact of the Biden proposals. And they sort of guessed that that might mean lowering that big $11.5 million exemption down to around $3.5 million, which again, that still means a married couple would not be subject to this federal tax unless they had more than $7 million in assets. But the difference between 7 and 23, I'm not a math expert, but I'm a lawyer, that's a big difference, right? And so the other area where the tax policy paper suggested there could be a change would be in that rate. So not only would you have a lower exemption, 3.5 million per person, but also a higher rate on assets that exceed that exemption of about 45%.
Okay,
So big change there.
increase.
Yep.
Okay, great. So so that was on sort of the estate tax side, and then on the income tax side, there were some changes as well.
That's
Both
right.
in terms of the rate on ordinary income, and then as well for capital gains.
Correct. So in general, again, the Biden proposal was to raise income taxes, right? So one way was the capital gains tax, and they were going to attack that in two different areas. First of all, what some people don't realize is that when you die, your assets receive what's called a step up in basis at your death. And so your heirs could sell, for example, a share of stock that had appreciated the day after you die and pay no capital gains on that asset because it's as though you purchased it the same day, right? If you have a share of Apple that's appreciated from $1 to $100, then if I sold it today, it would be subject to a capital gains tax on that difference. But if I die holding it and I pass it to my son, he could sell it the next day at no tax. And again, the Biden team said that doesn't quite seem right. And we would like to eliminate the step up in basis at death. So that was one of the proposals. And again, there wasn't a lot of detail around that. I think there were two ways that people talked about that may be working. One would be to treat death as a realization event, just like you sold it on that day. And so it was kind of, people were saying like a stealth death tax because you would die and then owe capital gains. Your estate, your heirs would owe capital gains. And there wasn't really discussion of some kind of an exemption for that. So while these exemptions were basically going to mean that most of the taxes would apply on earners making more than $400,000 in some cases, or more than $1 million in some cases, this capital gains change seemed like it could apply to everyone. Now, again, he didn't give a lot of detail on that, but there wasn't an exemption that he talked about. The only other way that we could think about when we were talking about how this elimination of step up would work would be to just keep carrying that original basis through the estate to the heirs. So if I bought that share of Apple for $1 and then pass it to my son and he sells it when he's 50 years old, he would somehow have to track that basis and pay capital gains on the difference in the growth, hopefully growth, between when I purchased it and when he was 50 years old. That seems like a really hard thing to track. So the Tax Policy Center in their paper suggested that death would be treated as a realization event for that one.
It's interesting. I believe Canada, actually, they treat death as a realization event, meaning that it's a tax on the capital gain at death. So it is not something that is kind of out of the realm of what other countries do.
And maybe we could steal their homework on how to draft legislation around that too. We wouldn't have to reinvent the wheel. So that was one, right? That was the capital gains change. And then in addition to that, it would be treat short-term and long-term gains the same. So right now you have this bifurcation where long-term capital gains are taxed at a lower rate. And the Biden administration said, that doesn't really make sense to us from a policy perspective. Let's just treat it all the same and tax it at ordinary income rates, which is the second tax that was proposed to be raised, right? We just think that the highest bracket should be a bit higher on earners specifically. The two kind of breaking points that the Biden administration tends to focus on are earners over $400,000 and then over $1 million as well. And in general, the policy was to raise tax, just more tax. We have COVID relief packages. We have this Tax Cuts and Jobs Act that lowered the rates. And so none of it was particularly, except for the capital gains realization at death, I don't think controversial, because prior to Trump's Tax Cuts and Jobs Act, we had rates basically in this arena. And so while it feels like an increase in taxes, and it certainly would be, it's nothing that we haven't seen before in the relatively not so distant past.
Yeah, short history that we're dealing with.
Right.
Okay, so capital gains, we were expecting that rate might increase, and that would be possibly a pretty substantial increase, correct?
Mm-hmm.
Yeah.
Yeah.
And then the possibly getting rid of the step up in basis, and then the increase in the or decrease in the estate tax exemption, possibly increase in the estate tax rate. So what are some of the actions that you were advising clients to take in consideration and with an eye towards these potential changes?
It was funny. It kind of turned tax planning on its head. Because in general, as we know, the best way to save taxes is just to defer paying them, right? So we have these great strategies like IRAs and 401ks, and you have these tax deferred accounts, and it allows assets to be invested and grow and compound tax free, which is a pretty great trick. Some of our clients were thinking about towards the end of this year, actually, it makes sense, right? If you think that the capital gains rate is going to go up, if you think that the income tax rate is going to go up, actually accelerating these tax realization events into 2020 to pay the tax at the lower rate. Now, not only would that involve maybe selling investments, but also at Brown Brothers, we work with a lot of business owners, private business owners and family businesses. And so those people actually have a lot of control over the timing of income, right? So, I work at Brown Brothers. I get a salary and hopefully a bonus. I don't get to decide when that happens. I don't get to decide that I'd rather have my bonus be paid early in 2020. Although, if some Brown Brothers partners are listening, maybe they would be open to that. But private business owners and family businesses have that flexibility. And so some of our clients were saying, to the extent I could pay a dividend in 2020 versus 2021, or pay my employees a little bit more this year, I might actually think about doing that, because again, it seems like there may be this, and people were calling it the blue wave, where you've got Democrats in charge of the Senate, the House, and the president, and then you really can have some pretty quick policy changes. Now, and we talked about this a little bit in preparing for this interview, it seems a little less likely that blue wave will happen, but we really won't know for sure until next year after the runoff for the Senate seats in Georgia. So we're still kind of in this state of uncertainty, unfortunately, in terms of planning.
Yeah, let's just catch up on that in terms of the political landscape at the moment. So we have, it looks like a pretty clear that it's Joe Biden has won the presidency. There's some controversy around that, but differences of opinion, but it seems that anybody who has knowledge in this area is saying that that's not going to change. And then the Democrats had control of the House of Representatives, and now they have retained control of the House of Representatives. And then the Senate is really now what's kind of on a precipice right now in terms of how that's going to go. And we have 48 senators who've been elected who are Democrats, and 50 who are Republicans. And we have these two Senate races in Georgia that have gone into a runoff, meaning that no candidate got a majority, and so they have a runoff election between the top two. Those are probably unlikely to go both for the Democrats, but it's possible that they would. And in that case, the Democrats would have control of all three branches. So that is still a possibility that we just don't know. We won't know until, I believe it's January 8th, maybe, is the runoff election.
That first, right. And the way that would work, right? Because again, we're doing so much math on this interview, a couple of lawyers, but you've got 50-50 in the Senate, and the tiebreak would be Kamala Harris if she's the vice president. And so that's where you see this so-called blue wave. But exactly to your point, Shannon, it's at least the pundits and the people who analyze this down in DC are saying it's unlikely that both of those seats go Democrat, but we don't know. And there's a ton of lobbying going on right now in Georgia, where there are Democrats saying, look, you came out for the presidential election. Don't forget about how important these Senate seats are. So I think everyone is kind of on the edge of their seat to say, are we going to have the voter turnout in the runoffs that we had in the 2020 election? And nobody knows.
I think that prior to this year, if anybody had said both Georgia Senate seats would end up in the hands of Democrats, people would have laughed at that. But it looks like it hasn't been called yet, I don't think, but it looks like Georgia right now, Joe Biden is in the lead. So it's very possible that if all of those people came out again, then both of those Senate seats could end up going to the Democrats. And then, like you were saying, the vice president, when there's a tie, is the tiebreaker. And so you would have a majority in the Senate, in which case some of these policy ideas or proposals that the Biden campaign, now coming in the Biden administration, had proposed, that it's a real possibility that they would take effect. While the Senate is still controlled by Republicans, it's probably not very likely. I would kind of.
I agree with you. I mean, I think the other area where there has been some talk is just former Vice President Joe Biden has a long history in politics and is known as someone who is able and has relationships across the aisle, has a good relationship with Mitch McConnell and many Republicans in Congress. And so while it certainly would be more likely if every single institution was controlled by Democrats, you know, if you have someone who can reach across the aisle and maybe can negotiate with some Republicans and encourage more bipartisan deals, especially in a year where we are going to need to raise revenue somewhere, just given the massive stimulus packages and COVID relief that will be necessary and remain necessary. I don't think that we can just say, okay, if the Senate goes Republican, one of those two seats, then there will be no changes at all. I think that it could be possible, even with a Republican-controlled Senate, that some tax changes are enacted before the next election. And we have to keep an eye on the midterms as well. We've got 2022 coming. And so to your earliest question, you know, what were people doing? They were just basically planning as though we do have these policies in place, doing things like accelerating income and maybe making gifts to their family members to get them out of their estates. In advance of what we think is probably extremely likely tax increases in some way, shape, or form in the coming years.
Okay. And it's important for people to realize as well that often tax changes could be retroactive in terms of that same year. So it could go back to January 1 of that year, which means that once the new year starts, you don't have the ability to act quickly and before these go into effect. So that's why I think a lot of people were talking about making sure that anything that you do want to do in anticipation of any kind of change should really be done before December 31st of 2020.
Yeah, that's a really great point. I mean, we think about the idea of retroactive taxation as being unconstitutional, right? You can't just impose a tax and make it retroactive. But the way that we understand that working is that if it's not a new tax, you could make some changes to existing taxes that are retroactive to the first of the year that they're enacted. And so, for example, the estate tax exists. If there was just a change to the exemption amounts, as we discussed, or a change to the rates, then it could be possible to have that be retroactive to January 1st. You know, what the tax policy paper says and what many experts are saying is that it's very unlikely that you could, especially given where the Senate is right now, that you could have a proposal passed so quickly that it's done, it's signed, it's enacted in 2021 and retroactive back to January 1st. Their numbers and their revenue projections in that paper that came out mid-October projected revenues based on the taxes being effective as of January 1, 2022. Again, not written in stone, but those are experts that are very good at predicting how this will all play out. And so even if he does get something enacted, it's unlikely that it will be next year. But again, to the extent people have control over their income and control over what transfers they make, all else equal, better to do it before the end of the year just to be safe, because we know the rules that are in place until the end of this year for sure.
And we could take a pretty good educated guess that tax rates are not going to go down next year.
Correct.
In the near future, right?
Yeah.
So, you know, in that case, you might be having the tax a little bit earlier, but you're likely not going to benefit from a reduction in tax rates in the future. So, so in addition to kind of accelerating tax, maybe selling any assets that have a gain, so triggering a gain. And again, this is where usually we would defer a gain and try to accelerate losses. Here, it's kind of the opposite, right? That anything that has a substantial gain, you might want to think about taking that gain now, rather than if you were thinking of maybe selling it next year in the near future, you might be better off selling it, especially if it's a stock, something you could buy back pretty quickly.
Yeah, I mean, I think that you phrased that perfectly. You said, as long as it was something that you were thinking about maybe selling next year. So I don't see clients and I don't see any advisors recommending that people sell things this year that they planned on holding for a very long time. But to the extent it was going to be, they have a concentrated position in one stock for some reason. Maybe they wanted to diversify that anyway. Then they're saying, look, all else equal, I wanted to diversify out of this over time. I'm just going to do it a little bit more quickly than I otherwise would have. But I don't see wholesale changes in investment allocation and an investment philosophy just based on taxes alone, especially given the uncertainty of what's going to happen with the elections.
Right. And in terms of sort of getting to that, like investment portfolio allocations, is there anything that you're advising clients on in terms of shifting portfolio allocations or selling any types of assets at this point?
No, and I think it's just because in order to get that decision right, you have to be right at 2 points in time and about two things. First you would have to be right about the future state of our country, who's going to be elected in the Senate, what's going to happen with tax policy and other policies in terms of Democrats controlling all three branches or not. And then you need to also be right about what that means for the stock market, right? So you look back at 2016 and maybe some people were right. I know many were surprised, but maybe some people knew that Trump was going to be elected president. They would also have had to be right in order to sell something ahead of that about what that meant for the market. So many people said, if Trump is elected, the market's going to crater. I think I should sell everything before that happens. But there were also people who said, if Trump's elected, the market is going to soar. And by the way, it did both, right, when he was elected. And so I think it's so hard to be right about both things, the future and then what that means for markets, that at least at Brown Brothers, what we're talking to our clients about is, look, on the margins, as the stock market goes up, make sure that you rebalance your portfolio so that if you say, I'm someone who's kind of a 70-30 type person, make sure that if the 70% stocks have increased so much that now you're looking more 75-25, that you rebalance. But that's just kind of good investing hygiene. It has nothing to do with anticipations for who will be in control of the government and what that means.
I like how you used investing hygiene. I had never heard that before.
Maybe I'll patent it.
But yeah, I think it is sort of going back to having the financial plan in place and working with your advisor and just staying on track, because nobody trying to predict the market is certainly, in my opinion, a fool's game. So the best thing is to just stick with whatever your long-term plan is. So I want to switch now to kind of a little bit away from the election and just talk about general year-end planning of we're coming up on, we're now, gosh, it's like this year is gone forever and in a blink of an eye, I feel like. And so we only have about a month and a half left out of this year. And as we said, taxes can change, but also just in general, there are often just year-end things that you might want to take care of or look at. So can you tell us some of the year-end planning steps that it might be good for clients to consider right now?
Yep, absolutely. And we have a great piece on this on the Brown Brothers website too. Towards the end of the year, we talked a lot about the estate tax and the gift tax. There's also this great exemption from the gift tax where if you do want to transfer assets to your kids, fund their 529s, get them a head start, there's a $15,000 exemption where it's not even treated as a gift for gift tax purposes, and you get that exemption every single year. And so, for example, I have 3 children, I could fund each of their accounts with an amount up to $15,000 each. I'm married, so my spouse could do the same. I could do it in 2020, and then I could do it again in 2021, 2022, a different amount each year. That $15,000 keeps coming back every year. And if you don't use it by the end of the year, it expires. And so we always check in with our clients towards the end of the year and just say, how much of that $15,000 have you used already? Maybe you paid some life insurance premiums. I know many of your clients, Shannon, have sort of life insurance trusts that own insurance for the benefit of their families if something was to happen to them while they were still in their earning years. You can use those gift tax exemptions to pay premiums on life insurance that might benefit your kids. And just to make sure that that's all cleaned up before December 31st, because if you don't use it, you lose it in terms of that 15,000. And then again, your usual kind of tax loss harvesting, right? You try to balance your gains and your losses while keeping aware of this wash sale rule. You can't just sell something and buy it right back. But those are all things that we look towards the end of the year once we have a full picture of the client's adjusted gross income and tax situation in November and December to make sure that we make their income taxes as efficient as possible. And then the last one I'll say is the charitable planning, which again is made a little bit more difficult this year because we don't know what the rates are going to be next year. But your charitable deduction limits are based on your adjusted gross income. And so it's hard to make these charitable donations, especially for really charitable people who try to get up against that limit in January, because you don't know exactly what your AGI is going to be. And so towards the end of the year, once we have a much clearer line of sight into a client's AGI, then we start looking at the charitable deduction and whether it would be more valuable to use this year or next.
Okay, great. And then as well, I think some of the other year-end things that we usually look to are like the 529 plans. If you want to maybe be contributing to a 529, that is as well, there's a deduction for, there's an income tax deduction in New York State that is yearly. So that's up to $10,000 a year, I believe, in New York State. So it does make sense often to give the, make a contribution of the $10,000 per year for the 529 account. And again, that's only per year. So it's going to be lost. Like you can't use $20,000 next year if you don't use it this year. And then as well, your retirement accounts, are there things, contributions that you want to be making to those accounts before the year end, and when while they can still be used against your income this year?
That's right. That's right. All of those things that kind of expire. And then really, we also just talk to our clients about while you're opening that file with all the tax planning, just take a quick look at your wills and make sure that the guardians that you name for your kids, the trustees, if you have any trusts, that those people are all still alive, competent, the right people to be serving in those roles. Usually it's just kind of a check the box and you say, yep, I still agree with what I did when I signed that document. But sometimes opening it up and taking a look reminds you that you need to make a change to one of those, which, I mean, as you know, Shannon, especially for a will, if you want to change a guardian or something like that, it's a very simple codicil or an amendment to a revocable trust, which I know we'll hopefully get to. It's not a big deal and it's not particularly expensive, but it's nice to keep those up to date too.
Yeah, absolutely. And I think this year has been a reminder to all of us that we really can't predict the future and anything kind of can happen. And you want to have everything in place when you're still able to do it and there's not some kind of, I mean, we were able to still work during the pandemic, but there was a mad rush, right? Like when the pandemic struck, of people wanting to do their wills and trusts and things. And so that really is a good reminder. You want to kind of keep those things in place and update it ahead of time, because if some kind of emergency like this strikes, then it's going to be really hard to get those things taken care of. And then I'll also just chime in that we are seeing a little bit of a move towards away from will planning and towards living trust planning. So avoiding probate, because we are seeing the effects of relying on the courts to process your assets, and the assets being tied up. The courts were totally closed for months with that, unless you had some kind of real emergency. And then even now that they're open back up, we're seeing a lot of backlogs. And so even certain courts, there was already backlogs before the pandemic, and now it's just really, really difficult. So that is something that I'm seeing in terms of a transition. One other thing that has kind of come up that I think is just worth touching on in light of the pandemic and changes that people are making, we're seeing a lot of people, and I've certainly talked to a lot of clients who are either temporarily living outside of the city, thinking of moving permanently outside of the city. Some people selling their apartments in New York, looking to buy in the suburbs. What do you have any advice? Because I feel like there can be some impulse buying at this point that we want to be careful of, and we are seeing prices dip down a little bit in New York and go up quite a bit in the suburbs. So do you have any advice for people thinking of relocating in light of the pandemic? And to be fair, I think that a lot of people are also, there may be people who just realized, well, I actually like it better in the suburbs. I've had it with the city, you know, like, or
right.
they've been planning this for a long time. And so it's like, well, I might as well just move now because there's no point in waiting at this point. So do you have any thoughts on those types of changes that people may be considering?
I have a lot of thoughts. I will say that the predominant one, and it doesn't take a tax expert or a lawyer to say this, is that when, in my experience, when clients move solely for tax purposes, they're not happy. And so to the extent that all else equal, you would stay in New York City, even the new New York City that we're living in today, then what we sort of refer to it as is like a luxury tax, right? So yes, New York has higher taxes than states like Florida, but you're paying to live in a certain area, and so you should just accept the fact that living in New York is more expensive than living in Florida, right? That some people think the biggest benefit to Florida is taxes, but the biggest drawback is that you have to live in Florida. Not that my parents live in Florida, so if they're watching, I apologize. And we do like to visit them in better times. So that's number one, but I think that's kind of a little bit too of a simplistic answer. You know, there are obviously going to be changes in the way states tax their residents based on the impact of COVID in particular on their economies. And so, Lai, I know I gave you a couple slides in advance. If I don't know if we can screen share it, but certain states, it would be great to start that now if we can, and I'll just keep talking in the meantime. But you know, certain states have been hit harder by COVID than others, and so if you're thinking about leaving the state or leaving the city for tax purposes, I think that you also need to keep in mind that that state's tax structure, while you know what it is today, could change significantly by the time you are actually a resident of that new state or that new city. So here what we have is just a color-coded map of the state revenue declines so far this year through August based on the prior year. So the difference in 2019 versus 2020. And so you see states like Florida really hard hit by this pandemic, right? They rely on tourism. There's not a state income tax. There's a lot of ways that Florida raises revenue for its residents that were not available in 2020. And then you look at other states like a Colorado, where they're just kind of fine in terms of revenue. And so if you're thinking about moving to one of these states that's colored in red or even orange, I would just keep in mind that that state's tax situation, it is going to need to balance its budget in some way, shape, or form. And so the tax situation today may be very different from what it looks like once you actually are resident there in 2021. If we could go to the next slide. In order to raise revenue, states have a lot of options. And so it's not just a guarantee, by the way, that Florida will suddenly start imposing an estate tax and an income tax and all of these things. They can do a lot of other things besides raising taxes on residents. And so they can spend their reserves, they can cut expenditures, they can pause some capital plans. One of the things they may do, though, is shift costs downstream. So this middle bar here, right, 37 of 50 states in the global financial crisis cut K through 12 education spending in 2010, right? They shifted that educational funding onto property taxpayers. And so if you're going to go buy property in another state because you don't want to live in this state anymore, I would keep in mind that in the global financial crisis, one way that states raised revenue was through property taxes. The bottom one there, I would say raising taxes other than property taxes on a state level probably would be seen as pretty unpopular and counterproductive in the middle of a recession. So, you know, our experts think that the likelihood of that is lower than some of the other options that states have on this page. but we don't know. And so, and I think that's good. Lai, we can take down the slides. You know, if you're thinking about moving for tax purposes to kind of sandwich all of that data with what I said earlier, don't do it. Move for a lifestyle, because it's really hard to predict the tax picture, especially in a year like this one.
Yeah, absolutely. I think that's a really good point. And I know a lot of times clients are thinking, oh, well, New Jersey doesn't have any estate tax. Maybe I should live in New Jersey. And of course, I remind them, well, you have to live in New Jersey to have that benefit. And but also a reminder that just a few years ago, New Jersey had one of the steepest estate taxes. So that could come back at any time. So it is a good reminder that if you are moving, that taxes can change. And so unless obviously if you literally can't afford to live somewhere, then rethinking where you want to be might make sense. We have a question that came in that I wanted to address, and I think this is something definitely a lot of my clients have concerns about, and that is the question of whether we think that the SALT deduction may come back.
It's a great question. In terms of kind of the top 10 items that the Biden-Harris tax plan has addressed, that is not one that we've focused on. But I think that, again, the focus is not going to be on more deductions in the next few years. I think that it's probably going to be, unfortunately, on higher rates. But as someone living in New York City, one of the highest state and city tax situations, I would love to see that come back, because that's something that impacts regular people who aren't these clients that are worried about the $11 million estate tax, right? That really impacts all of us on a personal level. And so I think it would be wonderful if it came back, but I'm not holding my breath.
Yeah, so probably not something we should count on. So, well, this has been really delightful, and I think it's really been informative for everyone listening. And thank you so much, Ali, for joining us. Any last words or thoughts that you want to share?
No, everyone just take a deep breath. We're going to get through this, and, stay inside and wear your mask, I guess. But, the tax landscape is as unclear as it's ever been. And I guess the last thing I would say on the tax part is, right now, the Tax Cuts and Jobs Act is expiring at the end of 2025. So even if nothing happens next year or with the midterms in 2022, we're always facing a shifting tax landscape. And so just planning with the rules we have in place today is really the best that we can do.
Okay, thank you. I think those are some great points. So hopefully we'll see you again soon. And
I love
hopefully
that. Thank you, Shannon.
that was informative. Thank you.